One thing about being a millennial is that we never run out of ways to lose money. In this video, I'll talk about the 3 main reasons why millennials suck at investing. If you're like me, the average millennial, then you probably had some troubles when getting started in the investing game. Maybe you would get started, make a few trades, make a little bit of money,
and then all of a sudden everything just keeps going down, down, down. Then you would get discouraged, start to pull your money out, and at the end of the day you had a 20 to 25% loss from your whole experience.
Sound familiar? Maybe not, but it definitely does to me. In my case, I would go through this cycle over and over and over again, because I would always think that there was a right time to get started investing. Always telling myself that I would invest if this happened, or I would invest if that happened, or anything in between. I just did not have a plan when getting started. This left me taking uneducated investments month after month, then getting super discouraged when I wasn't a millionaire and driving a Bugatti in 2 weeks. Then after 2 weeks, I would find some new toy to buy, then I would pull all of my money out of my investments, go buy that toy, and usually be left with about 20% loss on average. So most of the time, I was pretty much just bleeding money. And I say that to make the point that this is what happens when you don't approach investing with the proper mindset. The mindset of trying, failing, and not adjusting yourself before trying again. The process of trial and error is vital only if you make the correct adjustments. Also, every time I took a failure when I was investing, I would not think that it was me who failed. I would think that it was the investments who failed me. And that is a terrible way to approach any kind of investment decision. No investments will be so blatantly obvious that you can just make money right away. If it were, then some other experienced investor would have beat you to it way before you even had the chance to get started on it. It is the mindset that most millennials approach investing with that puts them at a severe disadvantage compared to other more experienced investors. The most burdensome thing about the millennial mindset is that we are so accustomed to getting things exactly when we want it. In today's era, patience is a thing of the past. I had to learn to change my mindset the hard way by making terrible investment decisions and learning from those decisions in order to be more effective in the future. So in order to combat this ongoing problem of the millennial mindset, I decided to create a list of the top 3 reasons why I think millennials suck at investing. Reason number 1 is that millennials want instant gratification.
There, I said it.
And I'm sure we can all agree that this statement is somewhat true. We are in an era of instant food, instant TV, instant downloads, instant. Everything is on demand and everything is right now when we want it. We are a generation that has become so accustomed to having everything right now, and investing is not going to play that game with us. Also, we have become so accustomed to seeing ads about people who got rich quickly and are now advertising their services so you can get rich as well. For those who are just starting out in the investing world, as soon as you look up even one thing about stocks, you are bombarded with ads about getting rich quick from options traders, day traders, everything in between. I can't tell you how many Timothy Sykes ads I clicked through when trying to find some information about passive income. Now, don't get me wrong, some of these influencers do have some good content to offer you in terms of basic knowledge about investment, valuation of some investment and assets, and a little bit more in between. But most of them are pretty much selling you a service to fund the actual way that they got rich, which is selling online courses. What you want to look for when you're trying to build your investment portfolio is a way to have a long-term wealth. When trying to build long-term wealth, you want to find something that you can invest in up front or build up front and let that investment pay you passively over the next few years. This is what is called passive income, and if you're just getting started in investing, this is like the 8th wonder of the world. Passive income is money that you make whether you're working or not. And in order to build a sustainable amount of passive income, you got to learn how to keep your emotions in check. As an investor, you have to be able to deal with the daily fluctuations that happen in the stock market. This is different from real estate because in real estate, you don't get to see the value of your house every second of the day, which causes a little bit less stress when talking about fluctuations in price. The reason why you want to keep your emotions in check is because the most confident you are about your investments, the more stable they can be in your portfolio. These investments, as I mentioned earlier, can be any kind of assets, from stocks, bonds, real estate, even shoes, anything that can provide you cash flow on a long-term basis. Ideally, this cash flow will be passive. Also, as an investor, you have to be able to do your own due diligence before investing. Don't let someone else do all the research for you and just tell you what to invest in, because that is not a recipe for success long term. If you rely on others for 100% of your investment decisions, you will be better off going to Vegas and gambling all of your money away. And also, it is much harder to predict what stocks are going to do in a short term rather than the long term. This is why, as an investor, you want to play the long game. For example, my first investment in the real estate market will be in rental properties. I plan to buy my first rental property by the end of this year or by mid-2021, depending on which opportunities present themselves. This is because I think rental properties and real estate in general are a great source of passive income and cash flow. With enough cash flow, you can potentially replace the salary that you're getting from your day job and be able to retire from the work environment entirely. So here's my recommendation on combating the problem of instant gratification, and that is to learn that you have to be more patient with the market that you are investing in. You see, the stock market is like a beautiful girl that you got your eye on. You don't want to just run up to her and start throwing money at her. That's not going to work. You have to get to know her. You have to learn what she likes. You have to learn what she doesn't like. You can't just go and just start throwing dollar bills and find the right girl. Also, you don't want to start chasing any old girl that your friends are chasing. No, you got to find your own girl, your own investment in order to be happy. Learn what makes her happy. Learn what makes her sad. Then you'll be able to use these references to learn how your portfolio is doing. The absolute worst thing you can do is structure your own portfolio based solely on what your friends are doing. And this leads me to my second point. Millennials get caught up in the hype. Let's take the Bitcoin bubble from way back in 2018, for example. I'm sure that we can all remember that when Bitcoin became popular, it was a craze across the entire economy. Everyone and their mamas was talking about this brand new cryptocurrency that was about to change the world. The currency was met with a lot of skepticism at first, but as the ball began slowly rolling and getting bigger and bigger and bigger, we saw more people jump onto the cryptocurrency wagon. This is because a lot of people was experiencing the sixth sense called the fear of missing out. This fear of missing out led people to taking terrible investment positions in Bitcoin and something that they knew little about just because it seemed like it was making a lot of people a lot of money. And as the ball kept slowly getting bigger and Bitcoin was slowly reaching its peak, the more experienced investors in the cryptocurrency began to sell off their assets, causing the demand to drop slightly. This slight shortage in demand was just enough for people to begin losing faith in the foundation of Bitcoin. This led to a few more people selling off their assets, and then a few more people, and a few more, and all of a sudden it was just a massive sell-off that led to a massive crash in the valuation of Bitcoin. What most millennials didn't understand is that what goes up must eventually come down. Let's look at the current stock market environment, for example. We have been in the longest bull run in the United States history. It would be foolish to think that it was going to continue up forever. This leads me to my second reason why I think millennials suck at investing, and that's because most millennials show up late to the party. You see, the millennial generation tends to wait till things are hyped before participating. They want to make sure their friends are doing it and they had a little success in doing it before participating themselves, because they want to have it established as cool before stamping their name on it. In the case of the Bitcoin bubble, by the time the millennials showed up to the party, it was already too late. Unforeseen at that time, a crash was just around the corner. And once the big crash did happen, all of the millennials who showed up late to the party and bought at the top of the Bitcoin valuation were now panic selling at the bottom of the valuation. They did the exact opposite of what you're supposed to do, and they bought high and they sold low. This is what is known as the behavior gap. If you want to see me do another video about the behavior gap, drop a comment down below and I'll do it just for you. The behavior gap is exactly what I said earlier, and that is when you buy high instead of buying low and sell low instead of selling high, and vice versa. In order to be able to combat the behavior gap, you have to know how to do your own due diligence and make intelligent investment decisions so you don't sell and buy things just because of market and media hype. I've learned all too often that it is very easy to get knocked off track when you don't have a plan. So making a plan and having the ability to stick with that plan will prove vital in your investing career. Lastly, the third reason why I think millennials suck at investing is millennials tend to buy cheaper stocks. Why spend $200 on one share of Apple when I can buy 5,000 shares of company XYZ for 1 cent a share?
more shares is better, right? Right?
Absolutely not. You have to understand that a cheaper stock price, in most cases, but not always, does not mean that you are getting more value for the asset that you are investing in. Price does not equal value. When investing, you want to focus on the quality of the stock that you're investing in rather than the quantity of shares that you are receiving for your money. And getting the most value for your money is what you should be focused on. This can be achieved by purchasing high quality companies for below market value. And to know what below market value is, you have to do your own due diligence. If you believe that a good company is undervalued for some reason, only after you do your due diligence should you put any money into it. After you confirm that it's undervalued, then you can then start adding shares to your portfolio. This requires a totally different mindset and a totally different work ethic than what most millennials are accustomed to. Not saying that we're lazy, but we just don't want to do the work and invest in every single stock we want to buy. But I like to point to one of my favorite quotes by my favorite investor of all time, Warren Buffett. Price is what you pay and value is what you get. So in conclusion, if you want to become a better investor, you must master these 3 things. Number 1, you must learn how to be patient and wait for the right opportunities. Learn the market that you are getting into before just taking a dive. Learn the ins and outs. Learn what makes money. Learn what loses money so you can look out for those things in the future. The second thing you must master learn how to do is learn how to educate yourself about different investing strategies. The worst thing that you can do is make an investment decision based on someone else's opinion. This is why you must learn how to do your own due diligence and be confident with your work before putting money into an asset. And lastly, the third thing that every new investor must master is knowing that more is not always better. Just because you're getting more shares of the cheap company XYZ does not mean you're going to get wealthier faster. Yes, if the price jumps by a smaller amount on the cheaper stock, then you may get more percentage gain, but it's just not a recipe for success long term. So with all that being said, I hope you enjoyed this video. If you like it, please hit that like button, hit that subscribe button, leave a thumbs up for your boy. It really helps out in the YouTube algorithm, help me grow this small channel. So it's free, leave a like for your boy, help me grow. I'll talk to you guys later. Until next time, peace.